What is a yield curve? Why does it matter to you? It's a question that's been going on for centuries in terms of people that invest in markets. The bond market is quite an interesting overall scenario in terms of how people look at it. It is quite big and scary sometimes, and that's why I think it's a really good idea just to have a very, very good overview and understanding of basically how it works. So what exactly is a yield curve? A yield curve, the best way to explain it to you, it's the compensation that investors get between short-term and long-term debt. Most of the time, under theory, as this chart shows you, you would expect that the longer out you go, the higher yield you get. Now, it's pretty easy to explain why that is that if you don't have your money for 30 years in terms of the amount of time you can buy an Australian government bond, just the longest we have, you would expect to be compensated for the fact that a 2-year bond is obviously a much, much shorter time. So that's why usually the bond yield slope curves up. The question though therefore becomes, what happens when you actually see a flat or inverted yield curve? Now, let's go on a little bit further. Basically, a yield curve goes flat when the premium, as we refer to it, or sometimes the spread of that, the longer term drops to basically zero, which is what we can show here. This is when, for example, the 30-year does drop to basically the same rate as a 2-year or a 1-year bond. It goes inverted when that number actually goes negative. Now let's have a look at the current bond yield in Australia, and you can see the 1-year is actually higher than the 2-year, 3-year and 5-year. The question that becomes from that is why? So why does it matter? Why does an inverted yield curve actually matter to overall markets, global economics, etc., etc.? Well, the way to look at it is that historically, the yield curve is a reflection of the overall economy that people see, particularly related to inflation. So investors who have an increasing bond yield expect inflation to grow, and as the yield steepens, they expect that that will continue to be a fairly typical thing because inflation needs to be offset by a higher yield as time goes by. And that's why a steepening yield curve is seen as an expectation of rosier outlook for economics and rosier outlook for things like possible rates on the upside. So that's when you start getting it sloping up. By contrast, however, if you start to see the yield curve flatten or invert, it basically suggests that the medium to longer term economics is actually likely to go the other direction. The market, therefore, and investors expect inflation to slow down, rates to be cut, and the overall economic outlook to be not as rosy as it currently is. And that's why it becomes such a very good indicator for looking forward in economics. It's why, particularly when you look at the US, they always talk around the inversion of the front end of the curve to the back end. And what we mean by that is that when your very short dated 3 months, 6 months, 12 months and 2-year bonds in the US become higher on their yield curve than their 10, 30-year or even as close as 5 or 8. And that's what we are starting to see in 2019. We saw it actually building in 2018. And that's why the 2-year bond is quite interesting, because for the first time since 2007, the 2-year bond yield is higher than the 10-year. Why the markets see this as quite a mover is that it is a big, big refresh and flash. And the reason for that is, again, as we've just talked about, in the next 2 years, they do actually see that rates and economic growth will probably be better than what it was going to be over the next 10 years. And that's what it's telling you. And that is therefore suggesting that inflation is slowing down, recession is coming. And that's the big indicator, because if you actually look back in history, there's a lot of really good data that shows this. But one of the big core Wall Street sort of rules of thumb is that when you see that happen, from 1900 all the way to today, it's almost 100% of the time it is predicted a recession in 18 to 24 months. And that's why the markets on equities, global economic outlook, etc., all reacts to things that happen in the bond market. It's an interesting time. There's no doubt it will create some sort of movements in markets. But overall, if you look at the bond market for that reason, it does give you a good indicator, but it's not the be all and end all.